Hello, everyone. Hi. Okay, so let's start with today's topic. Okay, so hello, everyone. Welcome. Sorry, it's always hectic at the front of the webinar. Okay, so I'm glad everything is working fine. Okay, so hey, everyone. Um, welcome to today's exclusive webinar brought to you by Vantage. How is everyone doing today? Okay, just say fine, good, just a short one in the chat box so that I want this to be a bit more interactive and I want to know where you guys are tuning in from. I see Philippines, I see Australia, I see Singapore. Let me know in the chat box. Okay, so we really get traders from all over Malaysia, Singapore, Indonesia, Thailand. Oh, Scotland, nice. And Europe or Australia sometimes. Sorry, I see someone talking to me on the Q&A box. Hi, Sharma. Hi, Sharma. Try to talk to me on the chat box instead of the Q&A box so that I can just reference one place. Okay, so I want this webinar to be super interactive. Obviously, not for those who are on Vantage app. I'm so sorry. I cannot give you that kind of attention because the chat is moving like crazy. Okay, so if something resonates with you, there's some comment and then just leave it in the chat box. Don't worry about delaying the webinar. I have no problem going over time if you guys want to stay a bit longer. I have nothing on today. So today I can go over time. So don't worry about interacting with me. Don't worry about asking questions and delaying the webinar because the whole point of Vantage bringing these webinars to you guys is so that you have a place where you can talk to a professional trader, right? If the whole point of this is just to sit down and learn, honestly, you can go on YouTube, you can go on so many places to learn. But being here in these webinars lets you have a bridge with the speaker so that you guys can interact and ask questions and just bring up whatever challenges you are facing in trading. Okay, so that's that. I'm gonna move on so that we'll have time. Okay, because yeah, I do need to spend a bit time on the disclaimer because legally I need you guys to know. Okay, this is not even just fun and games, it's legally I need you guys to know that this webinar is purely educational. Okay, please do not get me in trouble and treat this as a signals group. Okay, it is not a signals group, it is not any kind of financial advice, investment advice, or any kind of signal to buy or sell. Okay, risk warning: trading forex and CFDs, especially on margin, carries significant risk and is not suitable for all investors. Please do your research before you trade. Okay, it's the same reason you're not going to jump into the ocean unless you know how to swim, right? Because it's life-threatening. Trading is also life-threatening because you're going to lose all your money if you don't know what you're doing, and then you're going to get depressed, and then you're going to not live a quality life. Okay, so don't do it. Please learn first before you guys jump into trading. Okay, so that's why these webinars are here, so that you can learn. You have a place you can ask questions, you have a place where you can learn and grow. Okay, so very important reminder: trading is risky. Trading is very risky. I don't say that to scare you. I say it because it is the truth. Okay, it is not a get rich quick game. The market can move against you very fast. Okay, sometimes faster than you expect. You can make money. Yes, I admit I have made a lot of money from trading. I I'm grateful for that. Okay, but if you don't know what you're doing, you are going to lose money. Okay, you will lose trades, you will lose money, and you will get depressed. Okay, so please be humble in this game, be informed, and only take informed decision. Nothing about trading is emotional. Everything about trading is logical and data-based and just strict. Okay, so again, this is a place to learn, to grow, to absorb information, a place to interact with someone who trades, a professional trader, and this is not a signals group. Okay, so I'm gonna stay here for a minute so you guys can read through it. I think 1 minute should be enough, or maybe 2 minutes, and then we can move on with today's topic. I think I should be able to finish today's topic really quickly, and then, we can actually do a Q&A session. You guys can ask me stuff, you guys talk to me, tell me your challenges. In the meantime, let me just say hi to those who are on Zoom. Hi, Andy. Hi, Brian, Besh, Catherine, Sharma, Firefly dot AI. Hi, note taker. Hi, Gavin, Gabriel, Gula, Guada, or Rivera. Gula, sorry. Helen, Kai, Karsten, Mary, Fatima, Nina, Muhammad, Raul, Bob, Joash, Thessalonica. Hi. While you guys are reading that, hi. Okay, cool. I think that's more than enough time to go through the disclaimer. I'm gonna move on. So before I move on, I need to introduce myself. My name is Cassandra. So I'm the one that's gonna be going through this 1 hour with you guys. You guys can call me Cass. I am an investment analyst from Everest Fortune Group. So Everest Fortune Group is a third party research firm that Vantage has invited to do these webinars for you guys. We have been recognized globally as the finalists for the best Forex and best equity research multiple years in a row. My role here involves deep market research from macroeconomics analysis to technical price action and breaking it all down into strategies that traders can actually use. Other than that, I am a funded prop trader. What that means is I have taken prop trading tests and I have passed. To pass this test, I had to do 10% profit within a month. So a month is 30 days without the weekend. So it's actually 22 trading days because we are counting Monday to Fridays. And I've done 10% a month multiple times. I've been funded multiple times, and I do that mostly with technical analysis and yeah, mostly on technical analysis. So I would say I am an expert in technical analysis on reading the markets, okay, on price movement, okay, and yeah, you can ask me any questions regarding that. So my advice or tips to you guys is that trading is a daily survival skill. Okay, your only job as a trader is to protect your account first, then only you can think about growing it. If you don't protect your account, there's no such thing as growing it because there won't be an account to grow. Okay, so the reason I share all of this is not to brag or whatever it is, it's to give you confidence that you can be assured that the person that is speaking today comes from both research and real world trading experience. So my goal is to make you leave the sessions, whatever sessions I take with you guys, with insights that are practical, relevant, and applicable to your own journey as a trader. Okay, so your job is just to learn as much as you can and then see what you want to apply into your own trading style. And how do you do that? You back test. Okay, so agenda for today. Okay, first we'll talk about how wars and conflicts impact assets like oil, gold, and safe haven currencies. Every time a major geopolitical event hits the news, whether it's a war, a trade dispute, or a sudden political crisis, these assets tend to move first. We'll explore why oil spikes, why gold rallies, and why currencies like USD, JPY, and CHF often strengthens in times of tension. Secondly, we're going to see why geopolitical risk always leads to volatility. You'll learn the psychology behind market fear and also how volatility creates windows of opportunity. Because in trading, uncertainty doesn't have to be your enemy. Actually, when there is uncertainty, I am so happy because everyone is panicking and I know what to do. So it can be your edge if you understand how to read it and use it to your advantage. Okay, third, we'll go through real world examples like the Russia-Ukraine. Yeah, I think that the Russia-Ukraine, this is the one event that reshapes global energy flows, triggered massive volatility in commodities, and caused ripple effects across currencies from the euro to the yen. So I'll break down exactly what happened, why it mattered, and how traders could have positioned themselves in that environment. And finally, we'll wrap up everything with actionable strategies, particularly around safe haven trading. We'll discuss how professional traders use USD, JPY, CHF, and even gold as shields during uncertainty, and how you can structure your trades in volatile times. Okay, so let's go. So how wars and conflicts impact oil, gold, and safe haven currencies. Let's start with oil because when geopolitics gets messy, oil is usually the first to react. It's like the market's thermometer for global tension. So whenever a war breaks out, especially in or near a major oil producing region, like the Middle East or like Eastern Europe, like the Palestine and Israel thing, or like Russia and Ukraine, okay? These are examples, okay? Traders immediately think of supply disruptions, okay? Even before tanks roll in and sanctions are announced, oil prices begin to climb. Why? Because oil isn't just an energy, oh, sorry. Oil isn't just an energy source, okay? It's the lifeblood of global economy. Today's topic is not trailing stop loss masterclass. Oh my gosh, did they do it again? Can you guys give me a minute? Like, am I the problem or is Vantage the problem? Okay, let me let Vantage know. No, okay, so if you are on the Vantage app, right? Sorry, I just took a screenshot. So I am on Vantage app right now. I don't know if you guys can see because I cannot really see myself. On the Vantage app, it's scheduled to be geopolitics and the markets trading through uncertainty. So as you guys know, I used to do technical analysis with you guys, right? So those who have been following me for months or weeks, for months, right? I have been doing technical analysis with you guys. It's just that Vantage realized that there's too many topics on technical analysis. So now moving forward, I do fundamental analysis with you guys. Fundamental analysis is basically like geopolitical tension, news, the economy, about job losses, about nothing to do with the charts, okay? Nothing to do with the technical analysis, nothing to do with like trend lines, support resistance, okay? Support resistance, trend lines, Fibonacci, RSI, stochastics, these are technical analysis. Moving forward, since the start of last week, I will only do fundamental analysis with you guys. So I think there must be a miscommunication somewhere where I've been told to do fundamental analysis, but on Vantage side, they probably think I'm still doing technical analysis. It's Vantage is the wrong webinar. Also Wednesday is empty. Also the following weeks for Tuesday and okay, let me let I'm gonna thank you. If you have feedbacks, this is a good time to type it in the chat box. I'm gonna take a picture of whatever you guys are saying and send it to Vantage so that they know you guys are upset, not me. Okay. I don't want them to think I make like yeah. Let me just let them know. Hey guys, the topics are wrong again. Give me a moment, guys. Thanks for your feedback so that I know, uh, like we can solve this problem. It's okay. I've let them know that let's just let Vantage backend team work on that. So sorry, guys. I'm sure it was a simple mistake. I'm sure next week onwards it will be resolved. Okay, so thank you, Gula, thank you, Andy, for bringing it up actually, and thank you, Gavin. Okay, cool. I'm gonna continue with today's topic. I do want to stick with today's topic because this is the only this is the only slide that I have prepared for you guys. So if you guys want me to do trailing stop loss, I cannot do it for you guys because I actually have the slide for trailing stop loss actually. You know why? Because we've already done trailing stop loss. Trailing stop loss, trailing stop loss. We did it a few months ago. I have the slide for the trailing stop loss because this was a topic that was already done. But anyway, so let's just focus on today's topic and then we'll let Vantage solve the backend scheduling. Okay, thank you guys. So sorry for that. Okay, so we're done with let's continue with oil. So let's take the Russian-Ukraine conflict, for instance. Russia supplies roughly 10% of the world's oil, and even larger share of Europe's natural gas. Okay, when that war started, Brent crude exploded past $120 a barrel, not because production stopped immediately, but because of the fear of what could happen next. That's what we call a risk premium. Traders paying more for oil to hedge against uncertainty. So the same pattern shows up every time there's tension in the Straits of Hormuz, a narrow passage where a fifth of the world's oil passes through daily. So a single incident there, a drone strike, a naval blockade, or even rumors is enough, okay, can cause intraday spikes of 5 to 10%. Okay, so when you see headlines like US-Iran tensions rise, remember oil traders aren't waiting to see who wins. They don't care who wins. Okay, I'm sorry. As a trader, I don't care what happens in the war. I just know war is going to fuel my trades. That's all it is. Okay, unfortunately, if we're looking at a purely logical point of view, war is bad, but war moves the market. Okay, so they're reacting to supply fear. So as a trader, you don't need to predict wars. You just need to understand how they affect perception. Oil prices reflect fear of disruption, not necessarily disruption itself. Okay, my personal advice to you guys is not to get invested in anything war related. I try not to get involved. I try to stay neutral and silent at all times, no matter what war it is. I just keep my own personal views to myself. Why? Because like it just brings up so much negative emotions. So I just want to live. I just want to be good at in my craft, and my craft is trading. So don't let war affect you, okay? But you know, for us traders, right, we do need to research on stuff like this. So just look at it from a logical point of view and don't get sucked into the drama. Okay, so now let's talk about gold. The classic safe haven assets, whenever uncertainty rises, whether it's war, inflation, or a financial crisis, investors flock to gold like it's a world security blanket. So gold has this almost emotional pull. It's been a store of value for thousands of years. Long before stock markets or even paper money existed. So when people lose confidence in governments or currencies, they naturally move towards something they call touch and trust. So I got this picture from Google, and this is an example of what happens when there is war. Okay, so you can see spikes happening in index, in gold, in like a lot of things. Okay, whenever there is war, you can see spikes happening in the market. So during wartime, gold tends to surge because investors want protection from two main things: currency devaluation and market fear. For example, when Russia invaded Ukraine, gold spiked above $2,000 an ounce. When Israel-Hamas tensions escalated, gold rallied again, not necessarily because demand suddenly increased, but because confidence decreased elsewhere. What's interesting is gold also acts as an inflation hedge. Wars often drive commodity prices higher, food, fuel, transport, which feeds into inflation. When inflation expectations rise, so does gold demand because it's seen as a protection against loss of purchasing power. So whenever you hear the phrase flight to safety, think of gold. Okay, it's not just shiny metal, it's a psychological shelter for investors who hate uncertainty. I guess I like uncertainty because it moves the market. But in my own personal life, as a trader, I like uncertainty. In my own personal life, I actually like peace. Okay, so I don't like it. Okay, so finally, let's talk about safe haven currencies. Let's go to choices for traders during uncertainty. The US dollars, the Japanese yen, okay, and the Swiss franc. Okay, when markets panic, money doesn't just disappear, it relocates. Do you guys always, like, I don't know why before I was a trader, before I was an investor, I always had this like mindset or this like idea that, oh, it's a recession means that money is disappearing. That's not true. When a recession happens, it means that there is a transfer of wealth, right? The money is still going to be there whether there's a recession or not. Money is forever going to be there. It's not like just because a recession comes, suddenly the money just disappears. Suddenly you just burn your money off or something. It's not, it's just a transfer of wealth. Okay, so you see people becoming very poor, but you also see people becoming very rich during a recession. Okay, so it's just a transfer of wealth. And those who are not ready will be the one that gets burned the most. Okay, so capital leaves risky assets like emerging markets, currencies, or equity and flow into safer, more liquid assets. And because the US dollar is the world's reserve currency, used in 80% of global transactions, it naturally strengthens in times of fear. The Japanese yen behaves similarly, but for a different reason. Japan has a reputation for stability, low inflation, and massive current account surpluses. During global stress, Japanese investors often repatriate their overseas assets, converting foreign holdings back into the Japanese yen, which causes the yen to strengthen even when Japan isn't involved in the conflict. Okay, the Swiss franc, on the other hand, benefits from Switzerland's political neutrality and strong banking system. You know what? All countries should be like Switzerland. They are so neutral, they never get involved in anything. Okay, so whenever Europe faces turbulence from the Eurozone crisis to the Russian-Ukraine war, to whatever war or whatever is happening in the world, investors move money to the Swiss franc as a regional safe haven. This is why you often hear traders say the market is in a risk-off environment, meaning investors are pulling money out of risky assets and into safe havens. You see USD, JPY, CHF strengthens, gold rise, and equities fall all at once. So the next time there's geopolitical tension, don't just watch the headlines. You should be getting ready to know where to invest, okay? Watch capital flow. It tells you where the big players are parking their money when the world feels uncertain. Okay, this is just something I've heard before. I don't think it's real. It's probably just someone's idea. But I remember someone saying that war is sometimes is man-made. They purposely start wars so that the markets will move and people are making money, right? That's what I heard. I think it's just, I don't know if it's real, but yeah. Okay, so all right, so now let's talk about what assets move during conflicts. Let's talk about why they move so violently. Okay, so the short answer is fear. Markets don't actually hate bad news, they hate uncertainty. When traders don't know what's going to happen, they rush to protect capital. That's when we see wild volatility spikes, candles shooting up and down, spreads widening, basically chaos. Okay, think about it. If someone tells you inflation is 4%, that's bad, but it's known. You can price that in. But if someone says there's a war breaking out. We don't know how long it'll last or who's involved, and that's unknown. Okay, and the unknown makes traders emotional. That's when we see what's called risk off sentiment. Traders exiting stocks and high yield currencies and rushing into safe havens like USD, JPY, CHF, and gold. When confidence return, we get risk on, capital flowing back into equities, riskier currency, cryptocurrency, the risky stuff. Okay, so another interesting pattern during geopolitical stress is that what we call buy the rumor, sell the fact. It means the market often move before an event actually happens, based on anticipation, and then cool off once the outcome is confirmed. For example, in early 2022, oil and gold spiked just on rumors of an invasion. Okay, it was just a rumor. But when the war officially began, price briefly pulled back. Why? Because market had already priced in. Sorry, I've got a message from Vantage. Give me a moment. Okay. Yeah, Vantage will look into it. Thanks for highlighting, guys. Let me just turn off my phone, sorry. Okay, so yeah, it means that the markets is often move before an event actually happens based on anticipation. Okay, so for example, in early, like I was saying, there was a rumor and immediately price just moved. Okay, so the first rule when trading through geopolitics is to remember it's not always about events itself. Because can you share inside when markets is risk off, should we avoid, do they become neutral or risky, or which currency would be stronger from the three? Okay, very good question. You don't, okay, so someone is asking, when markets is risk off, meaning that there's no war happening, we're like happy, everyone is happy, like you don't need to feel fear, you don't have to. Sorry, when markets are risk off, right? Risk off meaning that, sorry, let me understand your question again. Market is risk off. Risk off means that you don't take risk. You don't take risk. That means you should be going into USD, JPY, CHF, and gold. Right? Risk off means that there is war. You should be going into safe haven metals. You should be going to like safe things. So you should not avoid USD, CHF, JPY, or USD, JPY. Those are the things that you actually should be going to because they become safer. Yeah. So the question is, when markets is risk off, meaning that there is war, there is tension happening, should we avoid USD, CHF, JPY, or USD, JPY? No, you should not avoid it. Instead, you should be going towards it because if there is risk, you should be going to the safe haven currencies. You should be going to the safe haven currencies. Which currency would be the strongest from the three? Okay, I cannot say for sure right now because they are all equally strong in their own view. Okay, I cannot give you the answer to which of these three will be the strongest, but I do, okay, my own personal is that USD will be the strongest, okay, because USD is always backed by people who are always protecting the US dollars because it's 80% traded in the world, okay? So USD tends to stay stable. I do notice, okay, this is just from my own experience, okay? I don't know the real, like if there is an actual factual answer out there, but based on my own experience, I noticed that the US dollars is constantly very strong no matter what. JPY tends to not be that strong sometimes, even if there is uncertainty happening. Okay, and CHF tends to be strong. So if I have to give a ranking, I would say USD, CHF, and then JPY would be the last. But gold will always top all these currencies. Okay, so let's talk about the next one, which is volatility. Okay, so the part that scares beginners but excites professional, volatility simply means movement. The movement is opportunity. When price moves fast, yes, it's risky, but it's also where traders make the biggest gains if they know what they're doing. The key is understanding what volatility cuts both ways. It's a double-edged sword. Emotional traders often panic, close positions too early, or chase big candles without logic. And that's where professionals step in. Remember, volatility is created by emotions, fear, greed, panic, right? When everyone's emotions, when everyone's emotional, liquidity floods the market, and that's exactly what seasoned traders need to enter and exit positions efficiently. And this is why many prop traders, including myself, actually prefer high volatility environments, because even though it's fast moving, it's also predictable in behavior. Risk off means capital flows in to safe haven. Risk on means back to growth assets like cryptocurrency, like things that like US dollar, sorry, like the Australian dollars, like the Canadian dollars. The trick is to stay calm while everyone else reacts emotionally. Okay, there are certain tools that will help you measure volatility. ATR, the average true range, okay, which is a technical analysis tool, can help you measure volatility objectively. You don't have to guess whether a market is going crazy today. You can just quantify it. The takeaway here is this: volatility isn't your enemy, fear is. Volatility is simply the reaction of the fear in price. If you stay logical while everyone else is panicking, volatility becomes your best friend. Okay? Okay, so I've got a question here. Why do this currency like the CHF or JPY strengthen during uncertainty, but as soon as war is over or whatever bad happening is over, it later weakens again very quickly, or sometimes it weakens even before the conflict is over. Okay, that is a very good observation, and that is very true. That's why I said I gave US dollars as, if I was giving a ranking, I gave US dollars as the stronger pair, the stronger currency. CHF, Swiss franc, and the Japanese yen. These safe haven currencies strengthen during initial panic phase because everyone's rushing in. Okay, okay, today I found out there's war happening. I'm gonna rush. I'm gonna run. I'm gonna start running to USD, CHF, and JPY. But once market realize that the worst is priced in, okay, the worst has happened, investors start moving out again into higher yield assets. It's like a wave. Fear pushes money in, and stabilizers pulls it back out. So that's why safe haven rallies often fade once the situation becomes predictable. But it's different for the US dollars, because US dollars is, people are going to use the US dollars regardless of whether there is war or not. You know what I mean? The US dollars is 80% traded in the world, right? It's being traded 80% of the time. So whether there's war or not, the US dollar remains strong. But when we're talking about CHF and JPY, people run in when there's fear, and then they're like, okay, wait, this is not that bad. It's not as bad as I thought it was. So then they start pulling out. Okay, so when you talk about rushing in, moving assets, I assume that you are not referring to CFDs trading then. No, I'm not referring so much to CFDs. Yes. But that being said, you can go long on CFDs. You can go long on CFDs. So like you can still use this information to your benefit, where you can go long on like USD, CHF, and JPY. But yeah, it works both ways. Okay, so case study, Russian-Ukraine war and its ripple effects on energy and FX. Okay, so let's rewind to February of 2022. Okay, I purposely chose to use the Russian-Ukraine war instead of the Gaza, the Israel Palestine war, because I know the Israel-Palestine war is a very emotional and sensitive topics to a lot of people. But like for some reason, the Russian and Ukraine war, it seems like people are not that emotional about it. So that's why I chose to use this as a case study rather than the other war. Okay, so let's rewind to February of 2022, the day Russian forces crossed into Ukraine. The moment that news hit global headlines, it was like a lightning bolt through every financial market. Oil spiked within hours. Okay, gold shot past 1,970, which at that time was really very high. I remember this clearly. I was like, whoa, gold is reaching $2,000. Okay, I remember it so clearly. And stock indices from Europe to Asia fell off a cliff. Okay, so traders didn't even wait for official sanctions. The word invasions was enough. Why such a strong reaction? Okay, because Europe relies on Russia for nearly 40% of its natural gas and around 25% of its crude oil. So overnight, the world realized that one of its key energy arteries might get choked. Okay, so the fear wasn't about the war itself, it was about what happens if the flow of energy stops. Sanctions came next, cutting Russia off from SWIFT, freezing central bank reserves, and banning energy imports. Each new sanctions, sorry, each new sanctions became a new headline that kept pushing oil and gas prices higher. Every time a country sanctions Russia, the price of oil just keeps going up. Okay, so I know a lot of the righteous people, like they're like, stop the war, blah blah, sanction. For those who don't know the economics of it, you because I know, like, you see on social media people always fighting for a cause, but they don't know how that cause actually affects the economy. Okay, so I was on social media and a lot of people like, yeah, sanction Russia, they're so bad, just keep sanctioning them. Every time you sanction them, to the country that is sanctioning Russia is hurting themselves and also hurting the world. But then people will be like, it's okay, it's for the greater good. Is it really for the greater good when you sanction them? Because you are hurting yourself, you're hurting the economy, and you are hurting your own livelihood. Okay, so that's why it is important to sometimes stay neutral. I don't know, I'm not a world leader, but when whatever actions people take during war, it will affect the economy one way or another. Okay, so wheat markets also went wild because both Russia and Ukraine are top grain exporters. So within days, we saw inflation headlines, supply chain warnings, and traders rushing into anything considered safe. The US dollars, the JPY, CHF, and gold. Okay, this was one of the clearest examples of risk off in action: fear, capital flight, and volatility. The key lesson: when geopolitical uncertainty explodes, markets don't wait for confirmation, they react instantly to perceived risk. Okay, so the biggest domino to fall from Russia-Ukraine war was energy. Okay, oil exploded past $120 a barrel. Every time a country was sanctioning Russia, you are actually hurting the normal everyday people like you and I. Okay, I mean, I'm not in Europe, so I didn't really feel it that much, but people in Europe definitely felt it. Okay, so $120 a barrel, natural gas prices in Europe surged over 300% year on year, and energy bills for households and factories literally doubled overnight. Okay, things are doubling, but your salary is not doubling. So the average human being, the average civilian, is actually suffering. This created a chain reaction that didn't just hit commodities, it hit everything. Okay, so when oil and gas rise, transportation and manufacturing costs follow. That means food prices go up, electricity goes up, and suddenly we have cost push inflation. Inflation forced central banks, especially the Federal Reserve and the European Central Bank, to raise interest rates aggressively. That in turn created volatility in the forex markets, because higher rates strengthen a currency and traders begin positioning for rate differential plays. So the story went from war to energy crisis to inflation to interest rate volatility. Okay, that's why I always, like, to me, whenever there is a voting or like for government or whatever, it is so important that you vote for the right person that runs the country. Because if you put someone in power who will just react to anything, like they just react, let's just sanction this, let's just free Israel, let's just do this. Like anything that you do affects the economy and therefore affects the average person. Okay. So therefore it's important, okay? So that's the domino effect of geopolitics. It doesn't stay contained in one sector, it spills into everything. During that period, gold became not just a fear hedge, but also an inflation hedge. By the way, do you guys know that gold is on an all-time high right now? Like, let me check. Gold is at a all-time high. The price of gold today is $4,110. Okay. There is 4134. Oh, thank you so much. Thank you so much, Gavin. Okay, there is fear in the market right now, and that's why people are going into safe haven. Okay, there is fear happening right now. Okay, so oil and gold move almost in tandem, one reflecting supply fear and the other reflecting monetary fear. So for traders, this was a golden classroom. You could literally see macro theory unfold live. When conflicts affect energy, inflation follows and central bank responds, giving traders opportunity across commodities, forex, and indices. Yeah, while we're on the topic, that's why I always tell, like, I have two kids, right? My only aim, the only thing I'm going to tell them is like, you have to be rich. Okay, I'm going to tell my kids, you have to be rich, you have to have a lot of reserve money, you have to have a lot of savings, so that whenever geopolitical tension happens, whatever is happening in the world, no matter who is bombing who is killing who, it doesn't matter, it shouldn't affect you because you are ready. And this is my same advice to anyone. You should always be ready. Always have like savings and stuff, because you don't know what's going to happen. And also when this happens, if you are a savvy investor and a very good trader, you can use that spare cash to throw in to like gold, for example, or like throw into like opportunities. I think I told you guys last week, or was it another? So last week, I just randomly went to check the price of Tesla, and the price of Tesla was at $450. Okay, I bought Tesla at $300 in July. Okay, the reason why I bought Tesla at $300 in July, let me see the price of Tesla right now. Okay, price of Tesla today is $435. So I think last week it was about 450. It went up to like 450. Yeah, so it went to about 450. I bought Tesla at $300 in July, or was it in June? Why? Because I had spare cash lying around and I didn't know what to do with it. Okay, so this is the, if you have money, just keep it, wait for the discount and buy. Why did I get into Tesla at 300? Because of news. So I think that was the time where Elon Musk said that Trump was on the Epstein's file, and then Trump and Elon Musk were like fighting, and then people were like selling Tesla stock. See, there was fear in the market. That's why people were selling Tesla stock. But I know Tesla based on research and based on whatever I've read up, Tesla is a company that is meant to last long. Okay, Tesla will be here for a long time. So that time when people were like heavily selling Tesla, I was like, oh my gosh, Tesla is so discounted right now. I have spare cash lying around. I'm just going to buy Tesla. 3 months later, I've made 50% in profit. Okay, that's why your job as a human, as a trader, as an investor, is to always save whenever you can to be ready when things get very discounted. Okay, when war happens, there's two things that you can do. You can run to the safe haven metals, sorry, not metals, safe haven currency, run to the safe haven metal like gold. You can go and buy oil. You can just go to the safe haven stuff because you want to stay out of risk. Or you can be like me. When war happens, I'm just like, okay, things are about to be very, very discounted. Tesla is going to go really cheap. Stocks are going to be very cheap. The index is going to drop. Everything is going to be discounted. And that's when I buy in, and then I'm going to see double or triple the rewards when things stabilizes. Okay, so there's two ways to play the market when war happens. Okay, you either become really safe, you put on your life jacket, you go into like US dollars, or you be like me and just buy the discount. Okay, so let's shift to currencies because that's where the geopolitical shock really translates into trading opportunities. When war begins, the US dollar immediately strengthens. Not because US was directly involved, but because USD is the world's reserve currency, the place global capital runs to for safety. Every time there's chaos, investors liquidate risk assets and park money in the dollars. Okay, which is exactly what I did as well. When anytime there is uncertainty, I will put my money in US dollar. My entire portfolio, 70% of it is in US dollars. Okay, I believe in the US dollars that much. The other 30% is in the Singapore dollars. Okay, I know a lot of these webinars you join, a lot of videos you watch will not talk about Singapore dollars. I personally live in Singapore, and I can tell you the currency is so strong. The currency is so stable. It is not officially declared as a safe haven currency yet, but I've read many articles where Singapore dollars is showing safe haven characteristics. Okay, safe haven currency characteristics. Therefore, I keep all my money in either the US dollars, or I keep all my money in Singapore dollars. And that's very ironic because I'm a Malaysian, by the way. I came from Malaysia. I would never, ever, I'm so sorry if there are Malaysians here. Okay, and I mean, there's something to be sorry about. I'm just stating facts, right? I would never put my money in the ringgit, which is the Malaysian ringgit. That currency is so, it doesn't show a lot of safe haven characteristics. So even as a Malaysian, I would never put my own money in my own home country because the currency isn't strong enough. Okay, so again, everything about trading and investing is purely logical. There's nothing emotional about it. Okay, because I don't want people coming after me saying, hey, why don't you put in the ringgit? Why aren't you supporting your own country? I'm not supporting my own country because my own country's currency isn't showing strength. That's all it is. Okay. So meanwhile, the euro, during wartime, the euro, especially the Russian and the Ukraine war, the euro dropped hard. Euro was on the front line of a crisis dependent on Russian energy facing record inflation and starting at a potential recession. So EUR/USD went from 1.14 to 0.696 in just a few months. That's a massive move in the Forex world. So the Japanese yen and Swiss franc, however, gained initially as safe havens, but later the yen weakened again because Japan's central bank didn't raise rates like the Fed did. Okay, showing that interest rate policy can override even safe haven status also once the dust settles. Okay, so emerging market currencies like the Turkish lira, South African rank, and Indian rupee all weakened as investors pulled funds out of developing economies to reduce exposure. So what's the big takeaway? Geopolitical events don't just cause volatility, they reshuffle global money flow. Okay, you could actually trace the migration of capital from risky to safe regions, from weak policies to strong policies, and that flow creates tradable trends that often last for months. Okay, so the Ukraine and Russia war was the perfect illustration of how energy, inflation, and forex markets are all intercepted. You can't look at one chart in isolation. You have to see the chain of cause and effect. Okay, so let's talk about strategies about safe haven trading, the USD, the JPY, the CHF, and gold. Okay, so now that we kind of understand how geopolitics shake the markets, it definitely shake the markets. Let's talk about how to actually trade through it. Whenever uncertainty hits, there's a predictable behavior we call the flight to safety. Okay, this is what majority of people will do. They will fly to safety. They will put all their assets, whatever it is, in gold. Okay, I'm different on the other hand. I like to be a little bit more risky. I like to go and buy the discounted stuff. Okay, big investors, pension funds, hedge funds, central banks, okay, all start moving their capital into assets they trust. Okay, they don't care about yield, they care about preservation. Okay, they don't care about yield, they care about preservation. That is the difference between going into safe haven assets and me, where I go and buy the discounted stuff. The difference is I don't mind if I lose money. Because to me, it's like, my ideology is like, oh, I have spare cash and this thing is super discounted right now. I'm gonna buy it at the discount. If I lose money, even though I bought it at a discount, that's okay. That's okay because it makes sense to buy things at a discounted rate. Okay, so for me, preservation is not the key. For me, the key is growth. Okay, so the US dollar is the first stop because it's the world reserve currency. 80% of global trade is invoiced in the US dollar. Okay, so when things go wrong, the dollar strengthened. How do you know when stock prices are discounted? Oh, let me show you. Okay, let's just randomly take. This is my free account, by the way. Okay, you know when things are discounted when you see a very big dip. So this is an example. This was the high at $400 and Tesla dipped to $100. Okay, this is a huge, huge discount. This is a 75% discount. Okay, so when this happened, a lot of people are going to run to gold. They're going to run to the safe haven stuff. People like me, I get excited because I'm just like, oh my God, things are discounted. It's just like going shopping and wanting to buy like a bag, for example, and the bag for some reason is like 50% off. And you're just like, oh, okay, I'm definitely getting this bag because it's on a discount. So for me, I it's so bad to say, but sometimes war excites me as an investor. Okay, as a human being, I think war is terrible. Okay, war is bad. For humanity, it's bad. Okay, as an investor, I'm just like, okay, war is coming. Things are about to get very discounted. So I get ready to buy when it's discounted. I combine this with technical analysis and with the news and technical analysis to find my entry. Okay, but this is just an example. Tesla is just an example. It doesn't have to be Tesla. It can be Forex, it can be stocks, it can be cryptocurrency, whatever it is. But when you see a discount, that's when it's time to get. FYI, topic for okay, can I just give me a moment? Let me just let Vantage know. How do you know when the drop is at the lowest point? That's why you combine technical analysis. With technical analysis, I'll give you guys a very good example. I don't know if I've ever shared this with you guys, but I got in on Ethereum in 2022 at $1,200. I got in here. How did I know to get in here? Mind you, the high of Ethereum was 4,008. Okay, 4,008 was the high of Ethereum. And I got in at 1,002, and I knew exactly where to get in. Why? You use technical analysis to help you get in. How did I do that? I used Elliott wave. Elliott wave already showed me that this was going to be the bottom. That this $800 will be the bottom. $900 was going to be the bottom. No worries, Catherine. Okay, so using technical analysis, you can narrow down where to get into your entry. So because I used Elliott wave, well, everybody was like, oh my God, Ethereum is going to hell. Ethereum is going to go to zero. I'm just like, no, it's not. It's going to stop here and it's going to start bouncing from here. When everyone was fearing, I was getting in. I made about 300% on this trade. I got in here and I got out at 4.4%, 4.4 thousand. I made about 300% on this one trade. Yeah, that's how you get informed, you get your information, and then you combine it with technical analysis. Okay, so where was I? I do need to finish today's webinar. We're on the last slide anyways. Okay, so the big investors will move into this safe haven because they want to preserve. Okay, so again, the US dollars will always be the strongest, answering I think Nina was asking just now, how do I know which one is going to be the strongest? Okay, so the US dollars, because it's mostly traded. Okay, then the Japanese yen and the Swiss franc, I guess I cannot say which one is more the stronger. I would say Swiss franc first, then the Japanese yen. Okay, they play similar roles for Asia and Europe. Japan has a low inflation and massive surpluses. Switzerland has neutrality and bank stability. Traders know these currencies don't move wildly. So they are great for capital parking during global stress. And of course, gold sits at the top as the multiple hedge, a tangible asset that doesn't deepen on any government. So as a trader, your first step is to understand the psychology behind these flows. When markets panic, money doesn't vanish, it rotates, okay? It is just money is flowing, okay? It's always flowing. Nobody, like, some people are going to become poor, some people are going to be rich. Just always know which side to stand. I don't know about you guys. I prefer standing on the side where people are getting rich, okay? How do you stand on that side? You are informed. You get information, you get data, you get knowledge will help you be on the winning side, okay? If you know something is going to happen, then you will have first-hand information. So if you can spot where it's rotating, you can position yourself with it, not against it. Okay, hold on. Let me just finish this and I'll answer your question. Okay, so let's translate the psychology into actual trading. Okay, so when all of this happens, what will become very volatile will be anything to do with US dollars. Okay, it's definitely going to be moving quite a bit. So when all this happens, definitely start. If you are in Forex, go and look at this and then it will have a lot of movement. Okay, so how do you do that? You can use this indicator called VIX, which is volatility index. Not indicator, you can use VIX, okay, which is an index. It's a volatility index to see spikes and global stocks indices like the S&P 500 drop, bond yield fall, or safe havens like gold and other dollars strengthening together. Okay, that's your signal that fear is driving price up. Okay. Let me just finish this and then I will answer your questions. Okay, so another thing you should do if you are not like me, like people like me, I get excited when things are dropping because things are discounted and I'm just like, okay, this is my chance to get really rich. Okay, that's me. Okay, but if you want to go the safer route, what you should do is to manage risk in volatile times. Okay, how can you manage risk? You can hedge, you can diversify, and you can forecast, and then you can, just diversify your portfolio and you can outsource. Okay, so that's basically the end of our webinar. I do have a Q&A session. I'm kind of over time anyways, but it doesn't matter. So Elliott wave, surely there is a key time frame that you use. What do you use and why, please? Okay, so I am someone who doesn't like staring at the market all day, every day. So I would consider myself a day trader, a day to swing trader. Okay, day to swing trader. I am definitely not a scalper. Therefore, for me, I reference a lot on the 1 hour and the 4 hours. Okay, but that time when I took that Ethereum trade, I was referencing the weekly and I was referencing the daily. Why? Because in 2022, I was not very active in the market, so I was referencing the very bigger time frame. A lot of people ask me, why is it called an Elliott wave? Didn't get you have to research on that. Okay, so for those who are confused what Elliott wave is, Elliott wave, so if you go on TradingView, this is TradingView, okay? Go to tradingview.com. There's a lot of ways to do analysis on the market. You can use all these indicators. Do you see all these indicators? RSI, Bollinger Band, parabolic SAR, rate, volume indicator, stochastics, up, super trend, technical rating. Okay, these are all the things that you can use. And you can also use these drawing tools here. You can use a trend line. You can use support and resistance. Okay, you can use support and resistance, blah, blah, blah. Okay, there's so many things on TradingView. Elliott wave is this here. Where is it? Oh my gosh, where is it? Oh, there you go. 1, 2, 3, 4, the fourth one. So Elliott wave is this one. So I just did a topic on Elliott. I just taught a group of people on Elliott wave. So Elliott wave is created by this guy called something Elliott. I can't remember his first name, even though I just did this topic. Okay, so Mr. Elliott, he noticed that price is constantly moving in a 5-wave patterns. 1, 2, 3, 4, and 5. That's what he noticed. Price is constantly moving in a 5-wave pattern. 1, 2, 3, 4, 5. Followed by a 3-wave pattern of a correction. 1, A, B, and C. Okay, so that's how I knew that this was the bottom because it looked to me like ABC was completed and I knew to get in for the buy around this area. So I got in at 1,200. I didn't get it right at the bottom, but I got it at a very good price. I'm swing trading, by the way, so I was holding for a very, very long time. Okay, I'm holding for a very long time. But anyway, technical analysis, Elliott wave is basically just another kind of technical analysis, which I no longer teach you guys as request from Vantage. I teach you guys everything to do with fundamental analysis from now on, geopolitical and news, okay? Technical analysis, I think, will be taken by my colleague, Peggy. You guys have you guys joined Peggy's webinars before, Peggy? Peggy is the one who will do technical analysis with you guys, and I am the one that's doing fundamental analysis from now on. Okay, technical analysis can be anything from indicators to drawing tools to Elliott wave to I don't know what else there is. Try all this. All of this are all technical analysis. Okay, all of this are technical analysis. Pitchfork, head and shoulder, channels. Okay, so my style of trading, I like to use Elliott wave. Okay, I love Elliott wave. Yeah, anything for EA, yeah. I like to use Elliott wave. Okay, so how does Elliott wave compare to head and shoulders? Oh, Elliott wave is superior. I'm sorry. Like maybe I'm biased because Elliott wave has made me so much money, but head and shoulder is a very, very, very basic. What is the head and shoulder tool? I know it's here somewhere. I've used it before. Okay, head and shoulder, oh, there you go. Head and shoulder is a very basic tool compared to Elliott wave. Elliott wave is, if I have to give a ranking of how advanced you have to be to use Elliott wave, I would say it is something you need to know, you need to understand very in-depth to be able to use Elliott wave. Elliott wave is not something you can learn in 1 hour, that's for sure. Head and shoulder is something you can learn in 10 minutes. You can go watch a video on YouTube about head and shoulder and you understand it in 3 minutes. It's very obvious. You basically identify a pattern on the chart. Does a shoulder, a head, followed by a shoulder. Okay, it's basically this pattern. Elliott wave is a totally different ball game. Okay, but yeah, I vouch for Elliott wave. Okay, so that's all I have for you guys today. I've already done the entire slide. I hope you guys learned something new from me, something interesting. I hope there's some kind of takeaway that added value in your life or as your journey as a trader. I will catch you guys next week. I take you guys every Tuesday, and I will every Tuesday again, starting from last week, teach you guys or share something about fundamental analysis, not technical analysis. So I'm not going to teach you guys things on TradingView. I'm going to teach you guys about news, about understanding the currency, about economics. So can someone email the link for the next week, please? Yeah, so I think Vantage will work on that. Vantage will work on that, and they will they will give you the link. They'll send you the link. Again, I am from Everest Fortune Group, which is the research firm. Okay, so I'm not really in charge of the back end on Vantage. That one is managed by Vantage themselves. My team was invited by Vantage to come and do this educational webinars for you guys, okay? Because our main job, our whole company focus a lot on education and research of the market. So that's what we are here to do for you guys. So anything else that is like back end stuff, you guys will have to email Vantage directly to get the help. Okay. Thanks, guys. Take care. I'll see you guys in a week. Bye.